So I'm James Carthew, and I'm the head of research at QuotedData, the investment company specialist. And I'm here today to talk to one of the managers of BlackRock American Income Trust. So could you introduce yourself, please?
Yeah, I'm Muzo Kayacan, so I've been a portfolio manager within the systematic active equity team at BlackRock for 15 years.
So could you explain to us what systematic active equity is, please?
Yeah, so absolutely. Some people might not have heard of us, and we're a new manager for the trust, but the team has been around over 40 years. And over that 40-year period, what we've been really doing is building and enhancing models that are used for stock selection. And what do we mean by models? It's kind of rules and data-based approaches to evaluating stocks. So rather than an individual, a person going out and doing detailed research into a particular company, we do detailed research into trying to identify what kind of data can predict stock price returns, what kind of data can consistently across hundreds or thousands of stocks predict their fundamentals.
And so when it actually comes to sort of building the portfolio and picking what stocks you're going to put into it, how much of that is driven by the data and how much of it is sort of down to you, your decisions?
In terms of the final piece, deciding what stocks to buy and sell, that really comes down to the model. What's the role of the portfolio manager and the researchers? Everything that comes before that. So this process that I talked about, identifying data that predicts stock prices, that's not a simple task. You get access to some Instagram data, and you could just run a back test and say, oh, it looks like Instagram data predicts stock prices. It's correlated with them over the last couple of years, but actually there's a very rigorous process in terms of saying, well, why? What's the sensibility? So the researchers will have to go and write a research report that has details on the data, the sensibility, and also some more rigorous testing. So for example, in that instance, our researchers showed that year-on-year growth in interactions with the company's brand on Instagram predict traffic to that company's website. And we have many, many years of internet traffic data that shows traffic to a company's website is a pretty good predictor of their revenues. So it's all about scouring the globe for new data sources and then very rigorously testing it. And then you get to the stage where you've got a signal, something that predicts stock prices. And then it's the role of the portfolio managers to combine lots of different signals together. There are lots of things, fundamentals, value, quality, sentiment, the macro picture, lots of different things, lots of different factors, if you like, that can be captured with data. And it's the role of the portfolio manager to build a model that incorporates all of these different data sources together, blends them together, and then you become the architect, if you like, of a model that picks the stocks, and then you also oversee it. You also become the risk manager. So there may be situations, there's an election, there's a war, there's an economic crisis where the portfolio manager needs to step in and maybe reduce risk or acknowledge that some of the data might not work for a little while. But for the most part, our job comes before the trading. It's that kind of architecture role, if you like.
So deciding what sort of inputs to put into the model, so
exactly.
what things to look at.
Yeah.
So you mentioned Instagram data. Can you give us another example of something that is a sort of a good indicator of where stock prices might be going?
And so I think that the way our model tends to think about stocks is along three pillars. So you've got fundamentals, which would be valuation and quality. How can you capture quality and growth with data? Well, the growth piece, you can now cast fundamentals with, for example, social media activity or web traffic data, mobile app usage, transaction data. You can now cast the company's fundamentals and get ahead of the market, hopefully on that dimension, or you can even capture quality. Companies that have moats, this can be captured with data. You can do text analysis on financial documents and find companies where people talk about their moats, their pricing power, their competitive advantages, their economies of scale. So in this way, you can translate text that people are writing into a moat score. Then you've got sentiment. What is happening with the company right now? They've just released a product or they've got a new CEO. What does the market think about it? And this is where we use text analysis. And we've actually been using text analysis for around 18 years. The tools are now much more sophisticated in the world of GPT. But it really enables us to have a virtual agent that is attending management meetings, but actually it's just reading the transcripts of earnings calls. It's reading broker research. We get 6,500 broker notes every day. No human being or even a team of 10 or 100 people can read all of those. And in this way, the machine, if you like, can take the market's pulse and take the pulse of management. Our brokers, our management getting more or less bullish or bearish, more or less cautious or worried. And then the final piece is macro. It might be a great company with great management, but where do they trade in the world? Do they export? Do they import? Are they an auto manufacturer? Are they a utility? And so we get data, for example, we've partnered with a software firm that provides electronic invoicing data to large corporations. They obviously can't give us their clients' invoices, but they can give us the data aggregated on a country or industry level. So now we get a pretty much real-time read on economic activity in the auto sector, in the construction sector, and this lets you take your top-down bets. And now the model can blend all of these things together to capture bottom-up, top-down fundamental sentiment, and you've got a very diversified, blended model that can capture pretty much anything that drives stock prices.
So you're using the Russell 1000 Value Index rather than the S&P 500. So the S&P 500's got quite a lot of the sort of Magnificent Seven, the big mega cap tech stocks in it. Does that mean that the portfolio has relatively little exposure to these stocks?
You're absolutely right. We've got a value benchmark, and that just naturally means you're going to have less exposure to mega cap growth stocks, some of which are very highly valued. But there's also, within that Russell 1000 value, what is key to emphasize, it's not zero in tech. There are technology firms in there that look attractively valued on certain metrics and get incorporated into the benchmark. And we think this is really a really nice property. You can all over the place get exposure to these stocks. There are plenty of funds and plenty of products, whether it's a track, whether it's an active product, that will have, they'll be following that benchmark, and they'll give you these exposures, which you may or may not be concerned about. But by giving investors a different option, giving them this exposure, this quite disciplined exposure to value stocks, that can be a really nice diversifier. We don't necessarily know exactly what's going to happen in terms of AI, how it's going to change the world, how it's maybe or maybe not going to translate into profitability for certain firms. And so by offering a bit more exposure to other sectors of the economy, more attractively valued companies, this can be a really nice diversifying property within investors' portfolios.
And I suppose if you're worried about that concentration risk, this is probably quite a good diversifier for your portfolio.
Absolutely. And again, it comes back to this point. It's benchmarked against the Russell 1000 value. Therefore, it's not going to have huge amounts of growth exposure. The market cap benchmarks do have huge amounts of growth exposure. So if you want something that still gives you exposure to equities in the long run, it's what makes equities such an attractive asset class. Well, you're investing in companies that can raise their prices as inflation goes up. They're exposed to economic growth. If they're well-run companies, they can generate very nice, long-term returns by taking market share from other companies. So yes, you get that attractive long-term exposure to equity returns, but with some diversification versus the broader market.
As to sort of win the contract and get everything done, you did a great deal for shareholders with the fees, and I think you waived the fees for a while. Yep. So once months, everything's sort of settled down, what would the sort of ongoing charges ratio look like?
The management fee was effectively cut in half. So at the current AUM, the management fee is going to be 35 basis points, and then with other ongoing charges for the trust, we should still have total costs below 1%. And now we're at the end of our 6-month discount period, so the fees, those 35 basis points fees will be what's charged on an ongoing basis. So those costs have pretty much settled down now. Yeah.
And you've also put some pretty punchy kind of discount control mechanism into the sort of structure as well. Can you explain a bit about that?
So absolutely. So we're aiming to provide investors with good value for money. It's not just about the fee, but do we provide something over and above, for example, a fund that could track a Russell 1000 value benchmark. So over a 3-year period, we'll be evaluated on our ability to outperform the benchmark. And then if we're not able to do that, there is an exit option provided for investors.
And obviously this is an income fund.
Yeah.
Can you explain a bit how the dividend works, please?
So we can offer, because of the way that investment trusts work, we've got the flexibility to offer quite a smooth, predictable return stream. So each quarter we'll aim to pay out around 1.5% of NAV. So that generally rolls up into a yield of around 6% a year.
And I suppose the big question sort of end up on here is, where do we think US equities are going from here?
Absolutely, it's the biggest question. And one thing that I think is important to consider, people will talk about, are we in a bubble? Is the market overvalued? Is the market undervalued? It's very rare that you would say an equity market or even an equity itself is just perfectly valued. There are expectations baked in. There are different people trading equities individually or collectively for different reasons. So really, being an equity investor, you have to acknowledge this fact that sometimes a market can be overvalued or a stock can be overvalued for a month or a year or 5 years. And sometimes things can stay cheap for a really long time. So for me, the question is, what are you trying to get out of equities? Take a step back from these headlines. Oh, can someone predict whether the market will go up this month or this year? It's really important to think about what equities offer in the long term. And again, some of the points that I made earlier, you'll get, if you've got exposure to good businesses, companies that can raise their prices, companies that can find ways to make themselves more efficient, companies that can maybe now in the current environment utilize artificial intelligence, and you've got a diversified portfolio and you invest for the long run, you're likely to be in a good spot, and you maybe don't have to worry about these things too much. But what I would say is you've got to remember this key principle. It's very rare that you can ever say equity markets are perfectly valued. There's sentiment there. There are people chasing things, but then sometimes markets also underestimate, how much of a return and how much growth a good company can generate. So I'd say, don't worry too much about the noise. Think about what equities offer in the long run, and don't worry about trying to predict the peak or the bottom to the day.
Brilliant, thank you very much. So really interesting, I think, then BlackRock American Income. It's diversified, it's relatively low charges, it's got discount control, and it's going to give you something that's a bit different from the kind of tech-dominated Mag 7 stuff, which is probably quite interesting for most people's portfolios. So thank you, Muzo.
Great, thanks for the questions.